All right, welcome back, everybody. Joining us right now with his outlook on the markets for the year is Jason Trennert. He, of course, is the chairman and CEO of Strategas Research Partners, which is a Baird company. And Jason, Happy New Year. Good to see you.
Happy New Year. Thanks for having me.
I don't know, by the Larry David rules, is it too late to say Happy New Year? It's just, this is the first real week.
I don't think so.
I
think January 6th, the way the
calendar
fell, I think
yeah,
you can
everybody's
still say,
like full-time back at work this week. So looking at where things stand for the year, how are you feeling about things? What concerns you? What are you excited about when it comes to the markets?
Well, listen, I mean, you're not starting off with the greatest springboard for returns, right? If you're looking at the stock market, you're at roughly 22 times earnings.
Right.
Okay, and you're at 10-year Treasury yields this morning. I think they're about 4.60.
Yeah, just above it.
We found over the last 2.5 years, anytime the 10-year Treasury yield goes above 4.50, the market tends to have troubles. There's been 3 corrections. 2 of them were associated with 10-year Treasury yields above 4.50. The third was the yen carry trade. So it's going to be hard to realize real multiple expansion this year. The expectations are for earnings to be up about 12 to 13%. In my opinion, that's probably the most you can expect from the market. But I also think it's going to be very choppy because you have the new administration that's trying to do big things, and whether they're successful in doing those big things will have a big impact on how well we do in the markets. DOGE is the thing, in my opinion, that excites me the most, excites our clients the most.
The efficiency program that Elon Musk and Vivek Ramaswamy are going to be looking at, trying to make the government a little more efficient. You know, what you just said, the idea of waiting to see how much gets done. Earlier this morning, we were talking with Axios, Mike Allen.
Right.
He was talking about this plan to try and do everything in one big, beautiful bill for the Republicans, to wrap it all together. Now, that I can understand the reason for doing that, thinking that it's easier, as House Speaker Mike Johnson has said, to convince everybody to vote for one big Republican bill than to try and convince them again and again to vote for these things, that you'd see more defectors. But it also comes with an awful lot of risk. It could mean that you get no points on the board, that nothing happens.
That's certainly possible, and I want to kind of stay in my lane here. I don't know. I mean, I
just want the market's reaction.
I think the market's reaction.
Are you good with waiting and hoping to try and get that big bill passed?
I think so.
Or would you like to see a win on the board?
Listen, the market would probably rather see a win on the board in the short term, but the potential impact, positive impact, would be much greater if you're able to get the big bill later in the year. And that's what will be the tough part about this year, is that if you're serious about fiscal reform, it's hard to not break a few eggs, right? I mean, it's just, and I do think, I don't want to point fingers, but the Trump administration is inheriting some things, whether it was student loan forgiveness, whether it was the TGA, whether it was the SPR. They're inheriting a little bit of a mess, I think, on the fiscal side, which if you want to correct those things, it's not going to be, it's hard to do them, hard to correct them without pain.
Part of the argument for this was that you wouldn't want the tax cut bill to be the last thing that you're dealing with and working on if you've already spent a lot of your goodwill, if you've already had those things that have come through. But I always thought that was the one issue that you might get Democrats to support, too, because who wants to say they voted to raise taxes on Americans?
Amen. And so I'm much more from a political, again, from a market perspective, you'd probably rather see less risk than more risk, right? As an American.
You like to go big or go home?
I think so. I really do. And I think that my own opinion is that also President Trump's political capital is never going to be as great as it is right now, right? So it's going to deteriorate, as we know, as we kind of get into the midterm elections. And this is the time, I would say, strike while the iron is hot.
But is there anything you would take out of that list? I mean, the issue, I think, is there's just going to be so much in there, and the number is going to be so high that if you are a fiscal conservative or part of the Freedom Caucus or something else, you're going to say no mas.
Well, you'll see. You know, I'm very much of the view that growth doesn't create inflation. That actually inefficient growth creates inflation. So if you're a supply sider and you're doing things to create capital formation, you can have higher growth and less inflation. So I'm not necessarily sure I necessarily agree with the Freedom Caucus on that score. If you're actually making a good faith effort, which I believe they will, to control government spending. Of course, there are a lot of vested interests in Washington, both Republicans and Democrats, that do not want to see that happen,
correct.
and that's going to be the big tension this year, and that's kind of the big kind of lie that a lot of people are for fiscal restraint, and then the fact of the matter is politicians are largely put on earth to give things away. You know, they're not to take things away or to act responsibly. It's not really part of the job description.
So let's get back to what you are telling clients for this year. If you're setting the scene that the springboard may not have a whole lot of spring in it because of what we've already seen to this point, where do you put your money to work?
So I think I don't want to make this overly complicated. My own opinion is that I do think you have to stick with AI because, as we've seen recently, the capital spending, if you get some sense the capital spending is slowing, that's one thing. But right now, I'd say your average CEO is more worried about not spending enough on AI, more worried about getting fired for not spending enough than spending too little. So I think that's going to happen. I think energy deregulation, so certain parts of energy, particularly LNG pipelines, LNG exports, I think they'll do quite well. Financials, I think you're going to see a lot of financial deregulation there. And I think the other big theme we're talking about is this idea of an industrial power renaissance, where if you look at what we're expecting of the grid in the United States between artificial intelligence, electric vehicles, cryptocurrencies, there's almost no way you can do this without in my opinion, leaning into fossil fuels or nuclear, or also making big improvements in the modernization of the grid. So in my opinion, that's like kind of that's another angle on artificial intelligence, in my opinion, that there's probably still some room in that trade.